How do you value a small business? One of the most important factors in the valuation of a business is its profit, how much money it makes. The problem is, instead of calling it profit, people use terms like EBITDA, earnings, adjusted net profit, cash flow, SDE, and others, and they all mean slightly different things. So what's the difference? And how do they affect the valuation of the company? Which is the right one to use? Let's start at the top. Businesses have income and expenses. At the end of the year, accountants add up all of the income and all of the expenses. In the expenses column, there will be things like staff wages, rent, the cost of goods, the owner's own salary, and many more. There will also be theoretical expenses, like depreciation. This isn't something the business has had to hand over money for, it just represents a loss of value. Another example is amortization. Once all of the theoretical costs are added in, the total expenses for the year are known. The net profit is simply the total income minus the total expenses. It's how much money the business has made after costs. This is also called net profit before taxation because tax hasn't been calculated yet. The net profit before tax is sometimes referred to as the pre-tax earnings, or the net earnings, or just earnings. They're all the same thing. So, this is the figure used in the valuation, right? Well, not always. Sellers of small businesses prefer to think about the total benefit they're receiving from the business, not just the net profit of the company. Remember the expenses of the business? Well, one of those expenses was the owner's salary. The owner is being paid by the business as an employee, as well as owning the company that earns the profits. So the total benefit would include the net profit and the owner's salary. In addition, the owner might receive benefits like healthcare, especially in the US, and other benefits. By selling the business, the owner would be giving up not only the net profit of the company, but also his or her salary and benefits. So some new terms were created. In the UK, people use the term net benefit to owner to describe the total benefit that the business provides to the owner. In the US, the equivalent term is seller's discretionary earnings, or SDE. This is the same thing. It's the total benefit of the business to its owner. In the US, sometimes this is also called cash flow, which is confusing because that's an accounting term that has other meanings. But as you can see from the most prominent business for sale websites in the US, they use the term cash flow quite a lot. What they mean is seller's discretionary earnings, or net benefit to owner, the total benefit of the business to that owner. So how is this calculated? Well, it's calculated by taking the net profit before tax and adding on the salary of the owner and any other benefits he receives, including some adjustments. Now remember those theoretical expenses? They're important. To calculate the net benefit to the owner, these are added back in. So depreciation and amortization are added back on to the net profit figure. Interest is also added back on since different owners have different debt structures. And finally, adjustments are made to the accounts. Sometimes there are add-backs that the seller believes should be added to the profit. For example, one-off costs that are not likely to be repeated. All of these add-backs increase the net benefit to the owner figure, making it higher than a simple net profit. There will sometimes be negative adjustments to make too. For example, if family members are working for free or for below market wages, they are artificially boosting the profit of the business, so an amount has to be deducted in most cases. Also, if the business owns its own premises but the new owner would be required to rent, then the rent at a market rate should be deducted to reflect this cost structure for the new owner. And there can be others like this too. The final figure after all of these adjustments is the net benefit to owner, or the seller's discretionary earnings, or SDE. This is also called the cash flow in US websites, and this figure could also be called the adjusted net profit. Now remember that buyers will have their own opinions about each of these adjustments, and they'll suggest their own version of the adjusted net profit. These adjustments to the profit are almost always the subject of negotiation. So what about EBIT and EBITDA? Well, these are very similar to the others, except for one thing. The owner's salary and benefits are not added back on. EBIT stands for earnings before interest and tax, meaning that it is simply the net profit before tax with interest added back on, since tax hasn't been deducted yet. EBITDA stands for earnings before interest, tax, depreciation, and amortization, meaning that it is the same as EBIT, except that in addition to interest, depreciation and amortization are also added back in. EBITDA is more commonly used than EBIT since sellers often like to exclude depreciation from their expenses. Also, it's simply a more commonly accepted approach. With EBIT and EBITDA, the owner's salary and benefits are not added onto the net profit, so these figures will be lower, but they are more commonly accepted metrics, particularly for larger private companies, where the owners would typically not be expected to be working in the business. So in summary, the net profit of a small business is the net profit before tax. This is simply the total income minus total expenses. EBIT and EBITDA are the net profit before tax, with add-backs like interest added back on. And the net benefit to owner, which is also the SDE or cash flow, is the net profit before tax with add-backs plus the owner's salary and benefits.